Real estate is a wealth building tool that has been used by the rich for hundreds of years, yet only 20% of Australians own an investment property. And out of that 20%, only 6% will go on to have more than 3 investment properties. And if you're under the age of 30, the chances of you owning an investment property is only 1.63%. So the question is, why don't more young Australians own property? And why do 71% of investors get stuck on their first property? Hey guys, my name is Zhang and I'm a self-made millionaire and a real estate investor. I have been investing in real estate since 2013 and have since built up a portfolio of 8 properties. In today's video, I'm going to share with you guys exactly how I was able to build up such a large portfolio in such a short amount of time and show you guys how your investment strategy might be slowing you down and preventing you from achieving your financial goals. If you find value in this video, please do me a huge favor by hitting that like button for the YouTube algorithm and commenting your thoughts, and consider subscribing for more content just like this. So without further ado, let's get straight into it. Let's start with why young Australians have such a hard time getting into the property market. The main reason why so many young Australians have such a hard time entering the property market is their beliefs, their mentality, and most importantly, their financial habits. A lot of things happen in our 20s. For the average Australian, we usually conclude our education, enter the workforce, and finally start making some decent money for the first time in our lives. And what do people do when they see large amounts of money for the first time in their lives? They usually spend it on traveling, food, shopping, and just about anything else out there that they might desire. One of the first things I did when I first started making money was to save as much of it as I can. And I did this by staying at home, eating at home, and avoiding unnecessary expenses and lifestyle inflation. If we start this practice at the age of 22 and put away $1,000 a month, which might sound like a huge amount, but it is only 20% of a $60K a year income. And if we do this for 4 years, by the time we turn 26, we will have $50,000, which is enough for a 20% deposit on a $250,000 property. I already know what you guys are thinking. It is impossible to get a property in Melbourne or Sydney for $250,000. And you will be correct. That's why we have to look outside of Melbourne and Sydney. One of my most profitable investment properties cost me $193,000. It is now worth $240,000 after just 2 years. That is growth that you're not going to see in Melbourne or Sydney. We will go over this in more detail later on in the video. Now, back to saving for our first deposit. The first property is always the hardest, and it will become easier every time after that. Your property will grow in value, provided that you buy the right property. And this means that you will be able to use the equity you build up in your first property as a deposit for your second property. And you can keep repeating this process until you are happy with your portfolio, or until you're able to retire off your rental income, which is my long-term goal. So the quicker you save a deposit and purchase your first property, the quicker this snowball effect can start happening. If you save $1,000 a month, you'll be able to buy a property in 4 years. But if you save $1,500 a month, you'll be able to buy a property in just under 3 years. And if you can save $2,000 a month, which I know sounds like a huge amount, but maybe you can do it just by starting another side hustle or gaining another revenue stream somehow, and this will make it much easier. And it is definitely achievable. And if you're able to do this, you'll be able to get a property in less than 2 years. Of course, there are ways to get into the property market sooner. This includes paying lender's mortgage insurance, which allows you to get into the market with only a 5% deposit. This is highly risky and I would advise strongly against it. But if you're absolutely sure that you want to do this, then maybe this could potentially speed up your investment journey. Personally, I have never made a purchase without at least a 20% deposit. I just prefer to be on the safer side, especially when it comes to large financial decisions like this. To summarize the first part, I want you to be frugal with your money. I want you to save between $1,000 to $2,000 a month and do this continuously until it becomes a habit. And by doing so, you are building strong financial habits that you will reap the rewards from for the years to come. Now let's talk about your first purchase. This is without a doubt the most important part of your investment journey. Getting this right will allow you to grow your portfolio much quicker. But if you get this wrong, you could get stuck on your first property like the other 71% of investors out there. The first thing I want to talk to you about is growth. Growth is what builds equity in your portfolio, and the equity is used to make further purchases, so it is absolutely crucial to our investment strategy. However, it is almost impossible to time the markets perfectly. Even the most experienced experts have a hard time predicting growth. The best thing we can do is to find properties with strong fundamentals and good growth potential, and hold these properties until the growth happens. To find the right property for you, you really have to do your own research and due diligence. But just to give you guys some ideas and inspiration, I currently have properties in Hobart, Launceston, and Bendigo. And the markets that I really like are Adelaide and Devonport. I know what you guys are thinking. Why on earth am I buying properties in such random areas? And why on earth am I not investing in the bigger cities like Melbourne and Sydney? Well, for starters, we will need pretty close to $1 million to invest in anything that is decent in either Melbourne or Sydney. And by decent, I mean properties that are in good suburbs, close to the city, and amenities. Even if we did have $1 million to invest, we'll still be facing a rental return of 2 to 3%. Which doesn't even cover the interest repayments on your loan. We will also be dealing with vacancy rates that is much higher in comparison to the markets I listed just before. Yes, Australia's capital cities will see much higher levels of population growth in the coming years, but they will also see much higher levels of housing supply. And properties in these major markets also cost between 100 to 200% more. And another thing to note here is that the growth in Melbourne and Sydney is not guaranteed to be higher than the markets I listed. As a matter of fact, the investment properties I purchased in these smaller markets saw a growth of around 30% in the last 3 years. And during this same period, Melbourne and Sydney saw a decrease from the 2017 peaks, meaning if you had purchased the property in 2017 in either of these markets and you sold at the current prices, you will be losing money. I recently made a video comparing Melbourne and regional Victoria in much more detail. So if you want to take a deeper dive into this topic, please feel free to check it out. And this brings us to our next point, positive cash flow and negative gearing. Both are great tools to use, but which one should we use for our first investment purchase? Well, this really depends on you and your circumstances. If you earn a lot of money and you want to safely invest that money into one of these established markets such as Melbourne and Sydney, and you don't mind contributing a bit of money every single month to service that mortgage, then negative gearing and its tax saving benefits are for you. However, if you're like me and you want your property to pay for themselves and give you a surplus of cash every single month, then you should be focusing on cash flow. I know some of these terms might sound a bit foreign to you, so let me explain this in a bit more detail. A property is negatively geared when the rental income from that property doesn't cover your interest and mortgage repayments. And a property has a positive cash flow when the rental income that is generated from that property covers all of your interest and mortgage repayments. There are a number of reasons why I prefer positive cash flow. The first reason is that the property will pay for itself. The rental income will cover all the expenses and repayments, requiring no additional contribution from you. The second reason is because it puts money in your pocket right away. The cash surplus you receive at the end of each month can be used for whatever you desire, but what you should really use it for is to save it and use it for your next deposit, so you can grow your portfolio much quicker. And the third reason is because I simply don't like the idea of making a guaranteed loss every single month, which is essentially what you are doing when you purchase a property that is negatively geared. For example, if you purchase a property with rental returns of 2% and the interest rate is 3%, then you have to contribute 1% every single month to service your mortgage, and that is your guaranteed loss. Hold on a minute, 2% rental returns and 3% interest. Why does that sound so familiar? Well, that is what the typical investment property in Melbourne and Sydney looks like. Now let's talk about the alternative. I will use one of my investment properties as an example. The property is in Bendigo. I purchased it 3 years ago for $210,000 and it gives me a rental return of 6.4%. And based on the current variable interest rate of around 3%, it gives me a cash flow surplus of 3.4% every single month. Obviously, that is oversimplifying it. I have to account for management fees, council rates, maintenance costs, and other expenses. However, after taking into account all of those expenses, the property will still generate a positive cash flow of 2% every single year. And 2% of $210,000 is $4,200. That is money that I can put towards my deposit for my next purchase. I must emphasize the importance of doing your own research and due diligence. If you're not sure about where you want to purchase your property, then you have to seek professional advice, either from someone who has done what you want to achieve or through a professional such as a buyer's agent. To summarize the second part, when you look to purchase your first investment property, I want you to look outside of Australia's major cities where you can often find much better opportunities. And I want you to find a property with strong cash flow. The last thing you want to do is contribute 1 to 2% towards your mortgage every single year. That is going to slow you down. And that is why so many investors get stuck on their first property. Now that we have discussed how you're going to purchase your first property and what kind of property you should be purchasing, we are going to move on to the juicy part and talk about how you can grow your portfolio from 1 property to 3, 5, or even 10 properties. To do this, we are going to use a $250,000 investment property with 5% rental returns as an example. After purchasing this initial investment property, we should expect a growth of at least 5% per year. This is very conservative and well below the long-term national average. And we are going to add 1% for cash surplus from rental returns. If we were to purchase this property in 2021 and we keep being frugal with our money and save as much as we can, we should be able to purchase another property in 2025. The thing to note here is that we should be aiming to increase our income in the long term. And as our income increases, the time we need to save for another deposit should become less and less. So in reality, we should be purchasing a property in 2023 or even 2024. And now for the best part. While you have been working hard to grow your income and save more money, your property has been working hard for you. After just 3.5 years, your property has achieved a combined return of 21% based on the capital growth and rental income surplus. And this puts you in a position to use the equity you have built up in that property to purchase another property. I hope you are starting to see the pattern here. Each investment property you purchase, provided that you are making the right purchases, will speed up the growth of your portfolio, as one property is refinanced to purchase a second property, and a third, and a fourth, and so forth. And guys, this is exactly how I was able to grow my portfolio so quickly in such a short amount of time. Again, this example is very simplified and it could take much longer for you to build up that equity, or it could take a much shorter amount of time if the market is performing well. The main thing to take away from all of this is that while we might see massive booms or corrections in the short term, over the long term, these properties will grow steadily and build you a lot of wealth. Alright guys, that was a lot of information. I hope you guys were able to make sense of all of that. But if you have any questions, please feel free to leave it in the comment section below and I'll try my best to answer them. To finish off the video, I just want to give you guys a few more statistics. Only 2% of property investors will go on to have 4 properties or more, and less than 1% of investors will go on to have 6 properties or more. Property investing is a lifelong thing. It's not something that you can get rich quickly from. If you're looking to get rich quick, sorry, but you are in the wrong place. If you want to succeed in building a multi-million-dollar portfolio, you have to change your mindset and enforce very strict financial habits. And based on statistics, a lot of investors are not willing to make that sacrifice. And if you're able to make that sacrifice, you'll be able to achieve what others can't. And this will set you up for life. With that said, that is only my personal opinion and strategy. It is not financial advice. I am definitely not a financial advisor. I'm just a guy who makes YouTube videos for fun. But I really hope this video was helpful to you. If you did find value in this video, do me a huge favor, hit that like button, comment your thoughts below, and consider subscribing for more content just like this. And I will see all of you guys in the next video.